All right, everybody. Hello, and welcome to our first ever YouTube video here for the EXP, well, the Jae Davis page or the EXP Elite page as well. So we're working in tandem, we're working together. I have my special guest tonight on with me, Miss Maui, and she is going to be talking taxes with us. Again, if you guys could go ahead and make sure you subscribe to my channel. Make sure you also hit the button to receive notifications on future videos that will be posted here on the YouTube channel. So we're going to go ahead and get started in a few minutes. If you guys have any questions, any comments that you want to ask, be sure to go ahead and post them in the comment section, and we'll be sure to go ahead and get to them. So without further ado, I'm going to go ahead and introduce Maui, and we'll get started. So Maui, tell us a little bit about your background.
All right. Well, I started doing taxes in 2006. And I started with H&R Block first, and I did around 2 seasons with them as a office manager, and then after that, I started working with the IRS. And what I did was to do a lot of social work for the IRS, doing advocate work for the seniors. So I did a lot of work with AARP for many seasons, and they actually certified me because I was a volunteer and because I was working for them. They certified me in everything taxes. So from business taxes to foreign income to senior citizens, retirement, and whatnot. So it was a really good experience because not only I was serving my community, but also I was getting the training that I needed, and I did that all the way down to still now. Really, I mean, I'm not doing it full time, but I have my clients that they don't want to go away. So every season we meet, and it's more exclusive now because it's just people that I have been working with for many years. But yeah, I love it. It has been very beneficial for me personally and professionally.
So 2006 to now, 2019, that's 13 years of doing taxes.
Yep.
So have you seen a lot of changes? I know you have. Just in this year, we're going to discuss that in a minute. But
yes, I think that the main changes have been this year because of the tax reform. Obviously, I have seen changes, throughout the years, but they were very mild changes or expected changes that everybody knew they were coming. But this year it really hit us because the more we read, the more changes that come, and I think that after the shutdown, we're gonna learn about more changes because they still, even the forms are not ready yet. So we know that from now until the 30th, they're gonna finish setting everything up for the new season, and that's going to be interesting.
So as of right now, can people go file their taxes?
No, they're not open yet. Okay. The season officially was supposed to start on the 30th.
Okay.
But because of the shutdown, we don't know. So that may take a little bit longer. But yes, you can file. You can fill out your forms, but you cannot file yet. So if you have a tax professional, yes, they can help you put everything together, but they cannot submit it yet. They're not open yet.
And when the government does open back up and people submit, will it be a delay in payment?
More likely. Wow. They're expecting a delay. President said they're gonna get their money. We know that eventually that's gonna happen, but when it's gonna happen, we don't know. So yes, there's gonna be a delay in payments. And the other thing that is affected is state taxes. Because the thing is that once federal opens, that doesn't mean that in our case Georgia will open right away. We don't know that. Florida, you guys don't have to worry about that. You're fortunate enough not to have the state taxes like Texas. But with us, then we have that delay for federal, but also we may have a delay for state.
Wow. Okay. A lot going on right now, huh?
Yes.
The government. Okay. So you when we spoke last week, you recently told me that you just came back from a training with the IRS.
Yes. So we did a training. The software that I have used for all these years is TaxWise, which is the same software that the IRS has.
Mm.
So tax-wise calls everybody that has that software and trains us on everything that is new.
Mm-hmm.
And that's where we learn everything about the new law. So it was, in the middle of December when that happened.
Wow. Okay. So let's jump right into it for all the EXPs. Explain, and I'm just going to talk from the perspective of being a individual who's executing events full-time and part-time. So let's start with part-time first. If you have a part-time job and you work as a brand ambassador or product specialist executing events part-time, but then you still have your full-time job or your part-time job, chances are you probably have a mix of W-2s and 1099s, correct?
Correct.
So what's the difference between the two for people who may not know or understand what a W-2 or 1099 is?
and I know that a lot of EXPs are very young, so it may be their first year or second year filing taxes on their own because before they did it with their dad and mom and dad or whatever. So yes, so the difference is that you will have to fill out basically two forms. With the W-2, your employer will deduct taxes throughout the year.
Yeah.
When you are 1099, you get the money as if it was cash. Nobody takes any taxes away from you, but you're responsible to pay, whatever taxes you need to pay at the end of the year.
Right.
Now, the advantage of that also is that you also have the right to make deductions, which we're going to talk about that a little bit later. But yes, you can deduct certain things because in a way you're a business owner. So whatever expenses your business has, you're allowed to deduct.
Okay. And then what is the amount that is taxable and non-taxable from a 1099? So let's say I work an event and it was just one event and I made $300. Do I have to claim that on my taxes? And it was 1099. And the company sends me a 1099 at the end of the year for $300. Do I have to claim that on my taxes?
Not necessarily. If it is not more than $600, you shouldn't have to do it.
Okay.
But I will say, for personal experience, because I was an EXP before, and I would say to every time that you get a check, either make a picture of it or keep track, because sometimes at the end of the year, you have several companies you work for, and you lose track of that.
Yeah.
So what happens is that sometimes you think, oh, that was just a short event. It was just 2 weekends. Yes, but those 2 weekends you made $3,000, honey. So guess what? You need to file those taxes, right?
Yeah.
So that money, what happens is that everything is going to be fine. You're going to file your taxes, but then once the IRS finds out that there was a 1099 that was claimed for you with $3,000 on it, and it's not on your taxes, they're gonna, go back to you and say, hey, you didn't file this, and that's gonna have penalties on it. So the best way to do it, I mean, you have a really good method that you UNT do, but I would say just take pictures, and maybe create a folder in your phone or in the cloud with all the checks that are coming in, and then at the end of the year, hey, this company still hasn't sent this yet. So for sure that you still have to wait for that, or call them or follow up and see where they're at, because sometimes they send it on your email and you didn't get it. So you have to follow up and be diligent on that.
So how long should you wait? When should we start receiving 1099s and W-2s from companies that we work for? And how long should we wait until we say, okay, I can go file my taxes? When is like the cutoff point for us to start receiving?
So technically, in a perfect world, before January the 30th, you should have your 1099 with you. That doesn't happen all the time.
No, it doesn't.
Some companies are a mess, and sometimes it's February and they haven't done anything. So I will say by the 15th of February, I will call and follow up. Hey, I haven't received this. What happened? Because technically, as an employer, you have until the 30th to send everything out. So.
And this has happened too with Maui doing our taxes. We got a 1099 for a company, and then it was one amount, and then 2 weeks later they said, oh, we we misappropriated the amount of money you made. Here's a new 1099, and we had already filed taxes.
Exactly.
So at that point, we had to do a
Amended return.
tax return to account for those funds. So it's important that you stay on top of, like Maui said, the companies that you work for, and you take record of what 1099s or W-2s you may be missing.
And it's also important to know before you work the event, at the time you do your contract, how you're gonna get paid.
Yeah.
Because sometimes they don't tell you that.
Yeah.
So what am I supposed to expect from you? Are you paying me with a 1099 or am I receiving a W-2? Also the per diem money.
Yeah.
You know, sometimes they do put it in there, sometimes they don't.
Yeah.
So be clear from the get-go.
Yeah.
And write it down and make sure that you have it, or you keep a copy of your contract or that email that you get, because they should disclose that up front.
Yeah.
How is that going to be accounted for? You know, am I gonna get a per diem that is not gonna be part of my pay, or yes?
Yeah.
Because sometimes they tell you no, and then you get the 1099 is for a larger amount than you were expecting.
Yeah.
So those things are important to kind of know in advance.
And sometimes companies, I found now, if you are a W-2 executing a tour, they tax your per diem. And why can they do that?
Well, you could in the past, not now, but you could in the past, you actually could deduct it, that per diem in a 2106. Not anymore. So I'm guessing that this year, once you start working events that way, they won't be able to do that. Or if they do, it's going to be taxed in a different way. Or they probably pay it to you as part of your check, and not like sometimes they give you the cash every day, or they give you money in a separate way. So that's going to change. But before, you could deduct that per diem on your 2106, which is not going to be part of your taxes anymore.
So if I'm working an event and I'm going to be a W-2, W-4 employee where they will be taking taxes out, and I'm filling out my W-4 form before signing up for the job, and I don't have any kids, should I put all zeros?
Yes, I also, I always recommend that even when you have 1 or 2 kids, because the good thing of that is, I see it as a savings account.
Okay.
Because in a way, since you have a mix of 1099 and W-2, right? Maybe you're paying more taxes in this job, but in this one, you're not paying anything.
Okay.
So it balances it, you know, it balances it out by itself. So I think I will just put 0.
How about if you're married? Like T, should he put 1?
He could. I mean, actually, what you put in your W-4, it only affects how much money you're taking out, but it's your personal decision. Like me, as a mom of 4, sometimes I just put 0 because I decided for them to take more. But then what I put on my federal taxes, that's what's, you know, the real thing. That's where I have to claim whoever I have to claim, and that's where I'm gonna get the deductions for the people that I have on my taxes.
Good information. Okay, so zeros, everybody, please.
Yes, it's
save
better.
yourself time.
And money.
And money, yes. So back to what we were saying. You are a EXP and you are doing this part-time, and you have a part-time job. Having a good mix of W-2s and 1099s is a good thing because it helps to
offset the taxes that they're not taking out as a 1099 EXP. So yes.
And what happens when you have more 1099s? Like you made more as a 1099 employee, you made $30,000 this year, but part-time you only made 10 or 15,000. So
what happens with that? I'm going to talk about 2018, right? So starting this year, whoever works as a self-employed person will get 20% exemption on their income.
Okay.
So let's say, going back to your example, right? You have $30,000 that came in as a 1099. 20% of that, right, will be right enough or exempt of taxes. Okay.
So it'll be 6,000.
Exactly.
Okay.
So $6,000 will be automatically subtracted from that. So
Mhm.
now your income wasn't 30,000. Now it goes back to 24,000,
Okay,
right?
right.
So over that 24,000, then we have expenses, right?
Mhm.
So we were talking about certain expenses that are not going to be accounted for anymore,
Yeah.
but certain expenses are still accounted for.
Mhm.
So let's say that you have, expenses like your phone or clothing or things like
Food.
that, food.
Gas.
Yeah, the meals and entertainment is not allowed anymore,
Mm.
but you can account it for food by itself in a different way if it is for traveling.
Mhm.
It's a little bit confusing, but before the meals and entertainment was only a portion of
Mhm.
your, they will take just a portion of it.
Mhm.
So let's say that you had $4,000, they only will count 2,000.
Mm.
Now they don't do that anymore. They do zero. They don't do nothing
Wow.
at all. But they do, you can claim it as part of traveling expenses if you're traveling while you're doing that.
Okay.
So you put all those deductions and you discount it from your 24,000 that you have, right?
Mhm.
Going back to that example, and then whatever is left, that's that's your taxable income. That's the money that you're gonna pay taxes on. So let's say that we have 24,000, and then expenses we have 6,000 more. Then we ended up with 18,000 only,
Mhm.
right? So over those $18,000, that's when you have to pay.
Wow.
Mhm. And then you have your standard deductions.
I was gonna
Okay?
say.
Yes.
Mhm.
So if you're single this year, you have a standard deduction of $12,000.
Mm.
So going back to that, we go again. We have the 18,000 minus 12. Now we have only $6,000 that we are going to pay taxes on.
Mm.
Okay? So now we go back to the example and we had $10,000 in W-2 income, but you were supposed to be paying taxes over those $10,000, so we shouldn't be worried about that anymore, right?
Right.
So let's add those up to the 6,000 we have already. That's 16,000, but we already paid taxes over 10, right?
Right.
So we only pay taxes over those 6,000 remaining, which
Wow.
shouldn't be that much.
Mm.
So it's good in a sense that the new law is good in a sense that they're giving you that break, that
Mhm.
20% discount basically
Mhm.
on your income, which before we didn't have.
Mhm.
But it also depends on your personal situation.
So if you have a full-time job and you are receiving a W-2 from a full-time job, let's say you made $20,000, $30,000 from your full-time job, and then you made, let's just say $30,000, and then from, as a 1099, as a EXP, you made $30,000 total, you're gonna file a 1040. What is the type of form will you file?
Yeah, you will file your Schedule C
Schedule
for
C.
the 1099, right?
Okay.
And your W-2, you will file it as part of your 1040.
Okay, together.
Yeah.
So that'll make your total
Your
income
income.
of
Mhm.
60,000 total?
But remember that the only thing that will be transferred into the 1040 from the Schedule C is whatever is remaining after those deductions. So it's not going to be the whole 30,000. It's going to be the 30,000 minus the 20%, minus all the deductions or expenses you had. That's what's going to be added on to your W-2 income. And that's going to be your AGI or your adjustable gross income.
Okay, and then from that, so let's say you got your W-2 of 30, and then after you do the math over here, they take the 20% off, we have 10,000 left, that's 40,000. So from there, the tax preparer can say, okay, let me see your deductions and start working.
No, the deductions are gonna be put on the Schedule C.
Oh, on the Schedule C, not on your,
No.
not together.
So we do the deductions first, that whatever is remaining comes back here to the 1040, right? So we have the AGI, the adjustable gross income, then after that, we have also student loans, interest that you have paid on that student loan, or we have IRA contributions or things like that. We put it in there, we subtract it from that amount. And then after we do that, we go to the deductions, which is the standard deduction for single people, 12,000, 24,000 for married. If you're a head of household, it's 18,000.
Explain that.
So what happens is that based on your situation, right, on your status, your marital status, the government will offer you a deduction. Okay. So for married filing jointly, okay, UNT, it went from 13,000 that was last year to 24,000 this year. So the government is giving you a $24,000 break, basically.
Thank you, T.
Yeah. Right? That's the benefit of being married.
Okay.
So then, if you're single, it went from 6,500 to 12,000 this year, right?
Okay.
And then, as a head of household, if you're a single mom, single dad, it went from 9,500 to 18,000.
Is this good or bad?
It's not good or bad, because this is the thing. They got rid of something that was part of taxes forever, which is shocking. It was shocking to me, but the personal exemption was removed from taxes. What is that?
Yes.
So before, they will count whoever was living with you. So let's say you and T were filing, right?
Yeah.
You will have personal exemptions, each one of you, of around $4,200 each. Okay. So we're talking about $8,400 that you already, just because you were living in the house together, they will take that off, right?
As a deduction.
As a deduction, right? It was a personal exemption. You were exempted from that money automatically. So let's say that you made 50,000 minus that 8,400, and then your income went down, right? Okay. So now they don't have that. So for somebody like me and Mike, we have 4 kids, right?
Yeah.
It was us plus the 4 kids, that's 6 people. So I lost a bunch of money.
Yeah, you did.
Right? So I cannot exempt that. The only thing that I can take is 24,000, which is not enough.
Yeah, it's not.
Right? So before it was the personal exemption plus the standard exemption. Plus the standard deduction. So 2 breaks basically. But now you don't have the personal exemption anymore.
One and they just raised
the other one. But they raise it to a point that it's going to be good for some people like you and T maybe, but for us it's not that good because we had 6 times 4, that's like
24.
That's 24,000 plus 13,000 we had last year.
Wow, that's 37.
That's $37,000 that we had, just because we were married and we had kids. Now we don't have that anymore. We only have the 24,000.
So what people like you and other EXPs who have children, is it still beneficial? Well, you're saying.
Well, in our case, then you go back to.
Because they had those signs that said, each kid you get 2,000 for this kid, 2,000 for that kid.
Yes.
Like, is that still the case?
Yes, you do get tax, your child credit.
Yeah.
But if you think about it, before I had that exemption, which was maybe not money that they were going to give to me, it wasn't a credit, but it was something that was subtracted from my income, which it helped me anyways, right?
Yeah.
So now, yes, I may have $2,000 per kid, but still, it's not good,
add
right? It's not adding up. It's not adding up. So it's. I don't know. It depends on your personal situation. Now the other thing is that with people like us, right?
Yeah.
When you're in that situation, usually, and going back to your question of EXPs that may have a family and kids, what you do at that point is that you go to the government and you say, I don't want your standard deduction. Sorry, it's not good enough for me. And I go with the Schedule A. Schedule A is an itemized deduction. And what I put there is the interest that I have paid on my mortgage, and that's when you have a mortgage, right? You pay real estate taxes, you pay ad valorem taxes, so everything that you have for your car, your tag that you pay every year, and you also can deduct certain medical expenses. So if that, when you add all that, is more, in our case, more than 24,000, then that's good, because you say, I don't want the 24,000, I have actually $30,000 in expenses, so that's what I want to use, and they will have to use that instead of the 24,000.
So how do you obtain that Schedule A? Is that something your tax account
Yeah,
prepares?
so they should know, if you're a homeowner, if you're, have a family, or in your case, you don't have a family yet, it's you and T, but you guys have property, so how much we have paid for interest and how much you have paid with real estate taxes. If that's more than 24,000, then let's use that form instead of the 24,000.
Okay, and it's still, okay, so we're gonna get into that next. So, independent contractor, so let's take the second scenario, which is I'm not working for anybody else. I don't get any W-2s unless I'm working an event, and I'm straight self-employed, and I do this full-time. What are the benefits to starting an LLC? Like, why should someone, like we talked about it and we decided to go this route because we hit a high income threshold and it just didn't make sense to keep filing personally. So why should someone move to that route? To just go, hey, I need to get an LLC to help, with me.
So when we did it with T100, it's because, as you said, you hit a certain income in which you will have to start paying taxes if you put everything on your personal income, right? So it was getting...
And personal income mean like your personal social,
taxes, yeah.
Your social.
Exactly.
Okay.
So what we did is that we established T100, and then you started giving that information out to all the companies, correct? And at that point, they will pay T100. They wouldn't pay J or T, right?
So what we had to do was, sorry to interrupt, we had to get a tax ID number through the IRS, and then from there, whatever state you live in, we then had to take that tax ID number and register our company with the state, in our case, the state of Georgia, to have an official name and LLC, then also set up a banking account, correct, to solidify us as an official business. So those were the steps that we had to take, and more than likely it's the same steps, right, that you'll have to take if you are looking to open an LLC. So continue on.
So then the checks will come to T100, and T100 will get paid. I remember that we still have a few that will come to your personal name or T's.
Yeah.
But most of the money will come to T100. So,
and the reason why, sorry again, is because some companies didn't take LLCs. They said, oh no, you only can work as a W-2 employee for us, not a 1099. Then we had to still file and use our social to claim the money that we made, or if it was under like a certain amount. I think me and T like under $400 or $500 or $600. Then we would just use our personal socials for that event, because it was just like a one-off event that we did with that company.
So when that happened, then T100 started getting all the income. I would say that the majority of the income, and we filed the 1120. It was a partnership, and we put all the money there, and most of the expenses actually went there. Okay, and the good thing about that was that at that point, you also were an employee of T100. So ADP was set up, which is the company that would use your payroll. It's user friendly.
Yeah, it is very easy.
It's very easy, and maybe Jay can give tips on that later on. But they assign themselves a salary. Okay, and this is so beneficial. I cannot tell you how good this is, because this is something that actually will allow you to get a house easier. If you want to buy a house or a property, the lender will go by whatever that W-2 says and whatever that that paycheck says, and that's something that you have control over, right? So you do that part, you assign yourselves a salary, and then on top of that, after everything is accounted for, including your salary, because as part of the deductions, whatever is left on that company comes to your personal taxes as a K1.
K1, yes Got it.
Okay, so now the K1 is also going to have a break this year. So that 20% that we talked about, the K1 is going to get too. So that's good.
Okay.
So then in our case, we had with T100, we had the W2s. We had the K1 and a few 1099, right? So we were able to have all the money there, yes, but it was already taxed for part of it because you had a W-2 for it, and then the rest, we had the deductions already made in the company side. So whatever came to the personal taxes was more clean, it was more, straightforward, it was like the net amount of what was made. And then we just incorporated a few other expenses that we were not able to incorporate in the business part of it. And most of the time, you guys didn't have to pay taxes. So that's what you do when you reach that point in which you say, "Ooh, I'm either combining my income with another self-employed person. My partner does the same thing that I do, or I'm getting good at this and I'm reaching the point in which it's too much money for my." Status, I'm a single person making $100,000. I have to see, where I can do this, or how I can do it. So an LLC has a lot of benefits, I would say.
And that's my next question, because your goal or our goal is to owe Uncle Sam zero or break even or get something back, just something. But okay, what's the difference? LLC, if someone's contemplating LLC, S corp. What partner? What else?
Yeah.
LLC,
So it's
S-corp.
LLC, S corp, or you can do an Inc. as well. I will say LLC. LLC because it's a limited liability company. You don't have any responsibility whatsoever. If something happens with the LLC, your liability is very limited to it. If you have a corporation, then it's not only the company's liability, but it's also on you. So that can go around and bite you. And actually, S corps don't have the breaks that.
That's what I'm gonna ask you. Who has the best tax breaks? And is it true with the S corp you have to file like quarterly?
More likely, yes. So
why
every 4 months, because usually it's expected for an S corp to have a higher income than an LLC. You could do this with an LLC too. You can do quarterly filing, but it's up to you. I mean, if it makes it easier, you can do it that way. But if not, then and usually what people does is not an actual filing. What you do is that you pay quarterly, and it's an estimated payment anyways, because at the end of the year you have to still file everything together. And if you overpaid, they pay you back. If you didn't, then you pay whatever is remaining.
Okay. So as a LLC now, we went that route. We got our LLC. We pay ourselves through ADP. So now we are employees of T100. And at the end of the year, we get a W-2 from ADP, but from ADP and for ourselves as employees of our company, which we then use to file our taxes, and assist us, with writing off things and doing that. So what is a projected or estimated amount of income someone should be making to even consider, maybe I need to get go the ADP route and pay myself? What would you say is like, if you're making this amount, then?
I would say it depends not only on what you're making, but what you want to do.
Okay.
Because I remember that when we started doing that is because we were contemplating the idea of buying properties, right? So I would say that if that's on your list of goals that you want to achieve, definitely do it.
Okay.
Even if your income is not where you wanted it to be, it's always better to have a W-2 income than having a 1099.
Okay.
Why? Because it's very simple. Lenders will, if you have a W-2, they will know that you have guaranteed work. Okay, it's more reliable, right? It's more steady. But if you have a 1099, who knows, right? And if you went from a W-2 job, let's say that you had a 9 to 5, and you were there for 5 years, and then you went and you started following Jay, and you went crazy and you sold everything you had and you were on the road and now you're famous and fabulous. That's good. But for a lender standpoint, it's like, you're not that reliable anymore because you don't have an employee. You know, you may and may not have tours now.
Yeah.
So they will ask you to wait 2 years.
Yeah.
And they want to wait and see 2 years of taxes
Of
to make
income.
sure that you really are making what you're saying you're making. Now, if you have that W-2 or that paycheck, you know, that you're paying yourself, then, you know, your situation didn't change much.
Yeah. And that's true, because she was our lender for 2 of our homes, and we would get to the last stage with the underwriters, and they needed W-2s, and they needed to see the income to establish credibility and the fact that you would be able, if we gave you this money, to pay
Repay it, yeah. And it's hard for anybody to understand the nature of an EXP. For any lender to see somebody with 20 W-2s or 20 1099s, that's a red flag. That's a no-no, right? I mean, it's like, what are you doing with your life, right? So I understood the nature of the job, which, you know, is totally different. But if you go to anybody to try to, you know, get $100,000 or $200,000 loan, you know, they really have to see that you are consistent on what you're doing. And for them, it's different jobs. It's not one job. For me, it was just one job with different companies because they know what it is. But for them, they may not see it that way.
Wow. Okay. So they have to make sure that they are very meticulous, and they, as an EXP, you are keeping account of income, expenses, and you are organized.
Yes.
Okay.
And that's another thing. I have worked with EXPs that are not organized, and I have worked with some that are very organized. And I can tell you that because of the way that you guys file, you may have a bigger target in your back for the IRS. So make sure that you are diligent on keeping track of everything, expenses and things like that. Because if you sit down with a tax preparer, they're gonna go with whatever you say, but at the end of the day, you're the one signing that 1040. It's not them. So whatever you say goes, right? And most people, they will just wash their hands and be like, okay, well, you told me, right? So make sure that you have proof of things. Maybe work with a bank that will have that option of keeping track of your expenses.
Or what is it, QuickBooks?
With QuickBooks, and just try to, you know, be proactive. You're a business owner now. You know, just switch your mindset maybe, because we are used to, if you were before working with a W-2, you probably didn't thought about these things, but now you are your own boss. You have your company, so conduct yourself accordingly and make sure that accounting, you know, even though we don't like it, is part of a business.
And you have somebody that's understands, right? Because that's the thing. You have to have people that know what they're doing.
Exactly.
So, by law, how far out can the IRS, from when you file your taxes, how long after can they audit you? How many years?
Oh, that's the funny part.
Did that change? Please tell me that.
No, they haven't.
Dang.
So it's 10 years. Okay,
Whoa.
they can go back 10 years.
Whoa.
You can go back. You can go back 3 years to claim credits.
Oh, I didn't know that. I learned
So
something
if they
new.
owe you something, they will pay back 3 years. But if you owe them something, they can go back 10 years.
Wasn't it 7 before? It's
it's
always
10.
been 10? Sorry, guys. I thought it was 7 years. Wow. Okay. Let's talk about, as an EXP, healthcare, the marketplace. So can we write that off? If we sign up for a healthcare plan through the marketplace, every month you've been paying to have health insurance, any dental insurance. At the end of the year, when you file your income taxes, can you add up that amount you've been paying every year and deduct it from your expenses?
Well, it's tricky because if it is through the marketplace, you're supposed to have something that they call it's something that they contribute towards
it is.
right? So you're supposed to be paying only a portion of what you were supposed to pay. So that amount, is basically a credit that they give you throughout the year. So at the end, what you're supposed to do is get that form that they send to you and give it to your taxpayer, and they're supposed to put it there how much you got as a grant or as a break or credit, and then put how much you pay. So if that balances out, usually they don't give you a credit, but they don't penalize you either. For what I understood on that training I got, there's not gonna be any penalties anymore.
Wow.
For health care, because they got rid of
Like parts
yeah.
of it, right?
Exactly. So portions of it are not gonna be penalized as before.
So if you didn't have health care last year and you went to file your taxes in February, March, and you didn't have health care, you wouldn't be penalized anymore?
You shouldn't.
Wow.
You shouldn't be penalized anymore.
Wow, interesting. Excuse that's Lucas in the background.
Oh
Excuse
yes.
him. That's
He's fine now. Nobody's killing him.
Oh man, okay, so that changed. Okay, so we covered LLCs, we covered W-2s, 1099s, and your income. We talked about that. Does your income matter, and when to switch to a LLC? So 20% deduction on self-employed income. We discussed that?
Yes.
Okay. And 20% tax deduction for self-employed filers, 20% deduction on all qualified businesses. So we
Yeah. So that means, with the K1, if we transfer everything here, it's gonna be a 20% deduction.
Okay.
20% deduction for all the income that you put on your Schedule C, so
Okay.
all the 1099 income. So all of that is gonna be subtracted.
Okay. I had a young lady ask me today at an event I went to. She said that she has an LLC already and that she made a lot of income on her LLC, and she knows she's probably gonna have to pay taxes. And she was wondering, should she start another LLC
No.
to help with deductions, or should she get an S corp and then, because she's trying to not pay the IRS anything. So what can you?
We're all trying to do that.
Yes. So
I will
what?
say no. No, because at the end of the day, the money's there, right?
Yeah.
So I would say deduct what you can deduct, right? Pay yourself and pay taxes over that only, in a form of a W-2, and then transfer the K1 to your personal taxes. And once you do that, you will have that 20% break. You should be fine. I think that for people with 1099s this year, you're gonna see a difference.
Okay.
Last year it got a little bit out of hand. The self-employed tax was higher than before. And I have seen certain clients already coming back with taxes with just a Schedule C, and I would say a Schedule C based on 76 or $50,000, and then with a net income of, I would say, 36,000, and they didn't have to pay much. And when I say that, it's they were paying, I will say, $1,200 only, which before that would generate an amount of sometimes $5,000-$6,000. So it's that 20% is making a difference, I will say, in a lot of people. So she may think that she has to pay, but she may not have to.
So as a EXP, things we usually write off are things that are common to write off: gas, food, travel, hotels, there's still travel, healthcare, mileage, uniforms, vanity like your hair, your nails. What else do we write off? Did I cover everything?
Well, licensing, like
like
professional
CDL,
assistance,
license,
professional or legal
training.
training.
What can and can't we write off?
Well, I will say that this year, if you do a Schedule C, you should stay around the same thing. You still can deduct your mileage. You can deduct your phone, because most of you guys, you work from your phone, do everything from your phone. So even photographs and headshots and stuff like that. So that will be a professional service. If you have to hire somebody to do that and create your portfolio, that's something that you can deduct. We
about-
know that next year that's gonna change,
Mhm.
and a lot of the deductions are gonna be taken off.
Mhm.
What was removed this year completely was the Form 2106.
Mhm.
And the 2106, what it did was kind of the same thing that the Schedule C does for 1099. The
Mhm.
2106 will do for people with a W-2.
Mm.
So if you were only earning your money through W-2s, like my husband, he makes money out of W-2,
Mhm.
but most of his income is commission, okay?
Mhm.
But it's accounted for as a
So
W-2.
they tax it.
So yeah, they will tax his commission money,
Mhm.
right?
Mhm.
So at the end, sometimes we put a 2106 because there were a lot of expenses he had
Mhm.
that were not reimbursed by the employer.
Mhm.
Travel expenses, if he had to go to any event
Conventions.
or convention or training or
Mhm.
things like that,
Mhm.
it wouldn't be covered.
Mhm.
So we use the 2106 for that. Well, guess what? We're not gonna be able to do that
Oh.
anymore because the 2106 is out.
Uh,
So 2106 is something that we're not doing anymore. Moving expenses, we were talking about that. So it doesn't matter where you move. You're not gonna be able to deduct that. Before it used to be, there was a rule in which if it was more than 50 miles, or if you were moving closer to your job, you were able to deduct all your moving expenses. The truck, if you have to stay in a hotel or whatever, that was a deduction. Now, not anymore. Okay, so it doesn't matter if you moved in 2018, sorry. And then, as I said at the beginning, the personal exceptions, which is per person in the household, is not gonna be done anymore, so.
Can you write off a portion of your home, like if you're using it as an office to like apply for jobs, apply for tours? Can you write off?
That is very, it was very,
Touchy.
it was a touchy subject on that training that I did because the office expense was part of the 2106.
Mm.
So my question at that point was, if they eliminated the 2106, can they still eliminate the portion of my house that I use as an office? The answer that I was given was no. But as I said, since I is still working on the forms, I don't know if there is gonna be a different form replacing the 2106 that is gonna have that deduction in it. Because I know that the office expense that it was part of the 2106. But it did make sense what he said to me. He said, no, we cannot do that because most businesses are going the route of having people working from home. So because of that, that's something that they still can deduct. But things like traveling back and forth or training, things like that, they're not gonna be able to deduct anymore.
Wow, because people, a lot of people have Airbnbs or they're like making money with multiple streams of income, and that's becoming a new way too. Like people having multiple streams of income and finding ways to, make sure that they maximize their return without having to pay back so much. Gosh, okay. And then, so if you're working, like if you're executing a tour for a company and you have gas receipts, you have food receipts from the tour vehicles and their assets, can you write that off?
If you had to pay for it and
Or
then
you're
you didn't
using a gas
reimburse,
card, or you're using like, you have a company card for gas, and you have food expenses and things, can you write
if they
off?
pay for it, no.
Okay,
If it is your car, yes.
okay. So
But if they're already paying for it, and most likely they're already writing that off as their expense, then you cannot do it.
Because a lot of people ask that, can they write off, like double write off? Like if the company's paying for hotels, but you get the hotel receipts and you get the points, can you use that as a travel expense?
No, if the company already paid for it, I mean, legally you cannot do that. Because
Okay,
then somebody else already is writing that off.
okay, that's good. So let's talk about homes and purchasing a home, because not only do you do taxes, but you are a lender
I'm a
as
lender,
well.
yes.
And there's a
So-
lot of EXPs who reach out to me about, looking for multiple streams of income, and one way is to get a home, to find a property, and to prepare themselves from a tax perspective, and both sides, to purchase their first home. What can someone do who is transitioning or who not necessarily has transitioned full-time as an EXP, but has more 1099s than W-2s, and they're looking to go ahead and purchase their first home, because every state may be different with the income thresholds. So what can they start doing to prepare to purchase their home?
So let's say that last year you were mostly 1099 and just a little bit of W-2s, and then this year it's kind of the same, but you never opened that LLC, right? So you're in the process of buying a house or wanting to buy a house, and then you hear this and you're like, oh crap, well now I have to wait because I didn't open that LLC. Well, that's not the case. If you already filed 1099 income on 2017, then 2018, what you have to make sure is that on that Schedule C, you have even the same or a little bit more income on that Schedule C from 1099 income. So let's say that last year your 1099 net income, okay, after all the deductions, your net income was around $30,000. Okay. This year you want it to be 30,000 or more. Okay, 35 or 40,000. So whoever does your taxes, make sure that you tell them, hey, I'm buying a house. I don't want to put that many deductions. And if you have to pay a little bit this year, well, that's part of your down payment. I put it that way.
Because they do look at deductions as a red flag.
Exactly,
right?
And not only that, they don't want to see that your income decline more than 5%. Okay, they want your income to stay the same or to actually go up. So if you're telling them, hey, I'm self-employed and I made 30,000 last year, but my business didn't do well on 2018, and now I just made 20,000. That's a red flag for anybody because so what's going to happen in 2019, right? So it is important for you to stay around the same amount of income on your Schedule C, which has your 1099 income on it, and then your W-2. Since the W-2 income that an EXP gets, it's very, I would say, sporadic and inconsistent. Most of the time they don't take that, but they could. If you had that and then you have it now, what they're gonna do is do a verification of self-employment and call these places and make sure that you work there. Sometimes it's hard because they don't answer the phone.
Or they don't remember, the account manager might have left, they don't work there anymore.
Exactly.
So you
it's
can't
very
really
frustrating.
verify.
I mean, it's better to go with just 1099 income, I would say, because that's something that your CPA or your tax preparer can just verify that yes, you have been self-employed for the last 2 years, and that if you use the money from the business to purchase the house, your business won't be affected. That's all that's all that a lender will look for. So I would say that's the best thing to do, to just make sure that your income remains around the same.
So sacrificing, I'm making notes as you talk so I can remember to come back to it. So sacrificing by getting less on your tax return is the good way to go.
I would say so, because a lot of people, and I know, I mean, we don't want to pay the IRS, but if we have an end goal in mind, which is a house, for instance, right? What I tell my people sometimes is, okay, yes, every year you get $5,000, and this year you're only getting $1,000. Well, those $4,000, put it in your mind as part of your down payment. It's as money that is going towards your investment, right? And once you do that, and once you complete the process of getting your investment, you may get even more than those $4,000. So just for a year, right? Just turn off that switch of wanting to get as much as you can from the IRS, and make sure that you're doing it in a way that it will be beneficial for you. Now, next year, you may have something that you didn't have before, which is the deduction of that interest payment, right? From your home, and the taxes that you pay, your real estate taxes, those are deductions. So you may get a higher refund, right? Next year, just because you sacrificed that 1 year to buy that house. So.
Wow. So it all works kind of hand in hand, but you have to know where your end goal is, and you have to have someone like you to kind of help you navigate through your taxes.
Exactly.
Because I'm pretty sure you've seen situations where people come in and they want to get a home and they think that they are qualified, but the taxes show otherwise, right?
Exactly. And it's sad because I know that these people makes the money. I know that they have good credit. They may have money on their bank account ready to go, but because they didn't want to pay the IRS, they made all the deductions in the world, and now they only have a net income of $10,000. Who lives with that? I mean, you can buy a house with $10,000 net income, so it has to make sense. It has to make sense, and you really have to have, like you said, you have to know where you want to go with your taxes, right? And it's important for you to also establish yourself long term. You know, it's good for anybody to see that you are investing and you have IRS, you know, IRA deductions in there, and your retirement income going out, that you have W-2 income coming in, that you have also a business. That's good for anything. I mean, it will help you, you know, move up financially, and get your investments and get your houses and do whatever it is that you want to do. But that's part of, you know, getting your credit and your income, I would say, flowing and going.
Okay. I got 2 more questions, and I think we're good. So let's talk about that worst case scenario. Let's say you do mess up on your taxes. You want to get a house, but then when you sit down with a lender and they say, hey, you showed $10,000 net income, we can't qualify you. How long does someone have to wait? Someone got a question. How long does someone have to wait? We'll get to that, to be able to get a home. How many tax returns will they do?
So if your income for 2017 was low, we still have time.
Okay.
Right? We still have time. And another thing that people doesn't know is that, let's say that 2018, you put, you know, the amount of money that you really made on your taxes, and it may have been a lot more than you expected, and you have something that you owe to the IRS. You can make a payment arrangement. You know, in our bank, for instance, if you have a payment arrangement set up and you prove that you made 3 payments, you're good to go. So it's not like you have to pay all that money, you know, all at once. We can work with you, right? So that's something that you can do. And people doesn't do it because they freak out. They think that that's not possible. So that's one thing. And then the other thing, let's say that you messed up 2018 already, and 2017, then we have to wait until next year, because that's when we file again, right? And then we calculate 2018 and 19, and that's your average income.
So when it's time for you to get your home, timing is everything. So you just have to make sure that you're setting yourself up and you're taking the steps, you know, financially to be able to obtain the things you want, but don't count a mistake as a bad thing, right?
Yeah, exactly.
Just
it may take a little bit of time, but it doesn't mean that you're disqualified automatically. But I will say that if your goal in 2019 is to get a house, before you file your taxes this year for 2018, go see someone. Okay, go to a lender before you file your taxes, and show them your 2017 taxes and 2016 taxes. You may be good to go, you may not. And they may be able to guide you in the right direction and say, hey, these are the mistakes that were made. Is there any possibility that this cannot happen this year? What do you think? Where are you, you know, in terms of expenses or income? So ask questions. There's no
dumb questions.
There you go. There's no dumb question. Ask questions, and surround yourself with people that does know what they're doing and guide you in the right direction. And don't listen to other people. Because everybody's an expert. So
everybody's situation.
So everybody goes, oh no, because I want to go to America, they already told me no, and then you go back, no, don't do that.
My homegirl Kiki hooked me up with
taxes.
And Kiki done jacked you up, and now you owe the IRS more money. Don't listen to Kiki, don't listen to Keisha, don't listen to
Kiki,
Mike,
Keisha.
nobody, because everybody's situation is different.
Exactly. And guess what? Your boy Mike is not going to be there when something happens.
And you got to pay.
Exactly.
Knocking on your door and taking your check.
Exactly.
Because you owe some money.
Exactly.
All right.
That's
So
true.
let's touch on retirement. You touched on IRA. Can you write off a IRA, traditional IRA, and a Roth IRA?
Mm-hmm.
Okay.
So yes, those are deductions that we have already, and
Okay.
and they weren't taken away, so that's a good thing. So save money. Saving money is actually a good thing because you can get a credit for
Mhm.
being a retirement, a person that is saving for retirement. So
So I know, like, because we are self-employed, we don't really have a nest egg. So with the Roth IRA, you can pay up to 5,500 a year. So are you saying that 5,500 a year that you contribute is
yeah, you deduct it, but then they also give you a credit
oh,
for
good.
for saving.
Okay, good. Okay. All right, let me get to these questions real quick. Oh, show live. Oh, I should do. Hey, ladies, so got your new info. So many changes, good and bad, considering that LLC. All right, so people are
Awesome.
considering it, and I think everybody's just saying good job. Valuable information for those who are independent contractors into the experiential marketing industry. All right, so this was our first YouTube video, and it went well. I'm pretty sure once we post it on Facebook and we get more
questions.
more questions that couldn't come through. But I'm trying to think before I let you go while I have you, if there's anything else as a contractor that I would want to ask. The main thing that came up in the group was the discussion about the new tax law, because they wanted to know how is it going to affect them as contractors. What are maybe some 3 takeaways tonight that you think they need to focus on with the new tax changes?
I would say pay attention to your income. That's one big thing. Pay attention to your income and your expenses.
Mm-hmm.
Pay attention to it. Your own owner. Your business, or you're a business owner now. So take ownership of that.
Mm-hmm.
That's number one. Number two, you have a 20% deduction now, which is it may be good for a lot of people. So before jumping to an LLC. Let's see how it went, how it goes this year with that 20% deduction. We may file taxes with only the Schedule C, and you may be good. Now, next year, if your income goes higher than what you have it for last year, you may consider the LLC as the best route. And number three, if your goal is to buy a house, I would say get yourself ready before you do so, and before you file taxes for 2018, right? And make sure that your income is consistent, that you don't have a decline of income on your self-employed income, because that's gonna hurt you. And then after that, I would say just pay attention to the changes that are gonna come up. I mean, I'm pretty sure that from now until the time the IRS opens, there's gonna be more changes. So we can update you through the website.
Yeah.
If I know of anything, I will let Jae know, and she can update you.
Yeah, definitely.
But more likely, I mean, it all depends on how much money you're gonna be making. But hopefully, it's gonna be good, and not everybody's gonna be hurt by the new law.
Okay. Bethany said, can you recommend a tax preparer in Pennsylvania that understands BAs and EXPs? I could send her a message later through Facebook if you know anybody in that area.
I don't on the top of my head, but I can try through the people that I know that trains with me to see who they have over there.
Okay.
I have a good person in New York, people from New York, that I can pass along the information on.
Okay. And do people need to be? This is a good question. Do people need to be sorry. Oh, got more stuff. She said thank you. Do people need to be physically there with the person when they're filing their taxes?
No, not
Okay.
necessarily. I did taxes for a lot of EXPs, and we did everything through email.
Okay.
But you have to make sure that that person knows the tax law for your specific state.
Okay.
So you have to make sure that they know what they're doing on your specific state. Again, Florida and Texas, that doesn't matter. You can do whatever, but
In any other state with no
any other state,
zero
if you
income
have
tax.
state taxes,
Mhm.
you have to make sure that whoever you're, emailing your information to is number one, a reliable person, and number two, somebody that understands the law in that state.
And if they are going to be, and even if you are going to be going to somebody or you're going to be working with someone remote, you need to have all your 1099s and W-2s to that preparer. You need to have all of your expenses itemized, recreated like a sheet. an Excel that where we would account for all of our expenses and have a total.
Are you passing that along?
Yeah, I'm gonna pass it along at the end of the year. I sent them a budget sheet. If you guys haven't already, just make sure you reach out to me via here on YouTube or Facebook, and I'll subscribe, and I'll make sure you guys get a copy of that. But you'll need your 1099s, your W-2s, your itemized, all of your expenses for that person. Anything else they'll need?
No, I mean, just, their previous taxes. So
Okay.
if this is not the first, this is the first time that you file taxes for that person, they need to see what you did last year.
Okay.
So make sure that you include a copy of that.
Okay. All right, so those 3 things are key to making sure that you are able to, file your taxes successfully and hopefully get some money back or break even. That's the
At
goal.
least, yeah, not pay anything.
So just want to thank my friend Maui. We go way back. We used to
Yes.
execute events together. Now she got 4 kids running around here. I'm trying to get on her level. But I just want to thank her, and she's doing it. She's a tax preparer. She's a lender. If you live in the Atlanta area, go ahead. Let's talk about Altira. Tell them where they can
Yes,
find you.
yes. They can find me. Well, my number is 404-993-3361. But you can also find me on Loans by Maui on Facebook. You can send me a text or just shoot me a message and I can help you out. Altera is not a conventional bank, it's not a traditional bank. So we know these situations, people with, EXPs, people that has their own company, even people with tax ID that doesn't have a social security number. We work all of those situations. So if you have any question or if you have, your house as a dream or goal this year, come see me.
Yes. Do you guys have remote offices in other states?
Yes, we do.
What other states?
We have Vegas, we have California, Texas, the Carolinas, Florida. So we have Philadelphia, we have New Jersey.
All right.
So, and I'm also licensed in other states. So if you want to come to me, I can either branch you out to somebody in that state, or we can work it through me.
All right. So EXPs in any of those states, as you heard, Maui can help you guys in getting your first home and making sure that you are setting yourself up financially and from a tax perspective to obtain that home. So thank you again for joining me tonight.
Yes,
and
good.
Thank you EXPs for tuning in. Make sure you guys like this video, give it a thumbs up, you share it with all of your EXPs, anybody who needs help with their taxes, and feel free to reach out to myself with any questions, and I'll make sure to filter them to Maui and get an answer for you guys within a 24 to 48 hour window. Enjoy the rest of your week, and hopefully this shutdown will be over soon and we can get these taxes done.
Yes, hopefully.
Bye.
Bye, guys.
Right. See how we end this video?